Okay, next week's an awfully big one for housing data. On Monday, you get the NAHB, the Housing Market Index, coming out. On Tuesday, we're going to see some housing starts. And on Thursday, existing home sales. So ahead of all this, we're bringing in our panel to get you ready for next week's trade. What do you do on the fundamentals? We've got Megan McGrath from MKM Partners on the technicals, Alex Bernal at Keen on the markets in Chicago. And on options, we have our very own Dom Chu. All right, welcome everyone. Megan, starting with you, fundamentally, what's your advice right now on the home building sector?
Cautious going into next week. The stocks had a relatively good week this week, and consensus is actually for two of those three metrics to be down sequentially. And even though it's in consensus, it's never really baked in the home builders. So we're a little cautious going into next week.
A little cautious going into next week. From a technical perspective, Alex, does that make sense to be cautious right now?
Well, I mean, I got to tell you, this whole sector is a disaster. From a technical point of view, I mean, all these stocks have been just like bumping along the bottom here. I looked at three different stocks today. I look at KB Homes, Pulte, and Lennar. And basically, if I had a gun to my head, Lennar is kind of the strongest of the three sisters. They have a very strong relative strength profile, but to be honest, I wouldn't touch any of them with the 10-foot pole.
Dom, when you look at the options market right now, what are you seeing in terms of activity? What can we sort of glean from the options market to take away about the sector as a whole?
Well, let's talk a little bit more about those technicals. I mean, it doesn't take a rocket scientist. If you look at the year-to-date returns just in Lennar, Toll, take a look at these numbers, because 33% for Lennar year-to-date here. Toll Brothers up 24%. Even the overall sector ETF, the XHB here, is up some 19%. Now, if you look at the options trade today, it's interesting because in this ETF, the XHB, which is the home builders ETF, the July $19 put options were $1.19 just about a week and a half ago here. Now they're 46 cents, so they've become cheaper here. The July $18 put options have gone down about 2/3 in value as well. The open interest here much more on the put side, so a very interesting mixed picture coming out here. But you can see some perhaps that trepidation coming into that next week's numbers here, especially with the July put options on these particular ones.
Well,
Trish.
it makes sense. I mean, Megan, when you look at the housing sector on a longer-term horizon, still you've got the reality check of the fact that there's so much inventory out there, that there's more inventory expected to come on with additional foreclosures. How can you get excited about this group, about this sector, given those fundamentals?
Yeah, I mean, I think we have reached a bottom. I think it's pretty clear, and that's kind of baked into the shares. But we're bouncing along the bottom. So we're waiting for a little bit of a pullback. We've been telling folks for the last couple of months, buy on pullbacks. It's a very volatile sector, very high beta. So if they go down on Greece news, for example, that might be a time to get into the stocks. But we're not. There's probably 10 to 15% upside in terms of our view for the space, and we'd like to see a little bit more given the high beta nature of the names before we get too much more excited about it.
But, you know, Alex, I was reading through some of your notes, and for a technician, you actually offered up some fundamentals, and you had a lot of concerns about housing prices and this housing glut that I was just talking about.
I mean, I'm from California, and basically, to borrow a phrase from Peter Schiff, you think housing prices are cheap now, just wait until interest rates rise to a historical norm. You know, that's when you're going to see the real bottom, the real capitulation. You know, people aren't going to be able to afford the record low interest rates now. You know, it's only going to get worse.
It's a very interesting point. Dom, I saw your acknowledgement of that point. You know, I guess I would counter, Dom, and I'm curious to hear your thoughts on this, with hopefully, if we're in an environment of rising interest rates, hopefully the economy is strong enough to support it, and thus housing prices would rise alongside it, Dom.
Well, interesting here, because let's take a couple points. First of all, you know, David Kelly over at JP Morgan Funds had this great notion that if you want people to go out and buy homes, the thing that you should do is tell them that they're going to be more expensive next year than they are this year. That's implying higher interest rates.
So maybe
here.
The Fed, right, needs to say we're going to move before the 2014.
It could be, but again, a great point here is that these are very much high beta names, and we'll talk about Lennar because it has been one of the real standouts so far this year. If you look at Lennar shares, they have doubled basically since the lows that we saw in the latter part of last year. You can see the chart there up some 54% over the past year. Again, from the lows, it's even more than that. But look at Lennar and how cheap it is perhaps to protect against the downside, because the 200-day moving average for the technicians out there, right, is just about 17-18% below where we are right now. Now, if you took a $21 put option on this particular stock, right? It used to cost you $110 for every 100 shares. Now it's only $50. It's 50% on sale. It might be one of the reasons why people are saying that, you know what, this might be the time, if you feel like hedging out some of your risk here, it could be a little bit cheaper now to pay for that downside insurance than it was just a week and a half ago.
Quite possibly. Okay.